Hello, hello. You're listening to Paradigm Shift, a podcast about people building the future in pivotal moments in their journey. I'm Ashish, and I'm joined by my co-host Zain. And today, we're thrilled to speak with Shamir Karkal about founding Bank Simple in 2009, which was the first neobank and one of the most inspiring fintech products, ushering in a decade of fintech innovation and growth. We'll also talk about his current company, SIla Money, in the Finnovation Group he runs, which is a group of over 3,000 builders and innovators in the space. Shamir, thanks for joining us today.
My pleasure, Ashish and Zain.
So you have a long career in fintech and you've seen it from its early days to where it is now. So maybe we'll start with the early days of your career. Do you mind telling us how you got into startups and software and fintech in particular?
Well, I started my career as a software engineer, right? That's what I studied in undergrad and a master's, and then worked as a software engineer for a few years, starting in India, but then also in Japan, and then came to the US. Kind of almost accidentally, I ended up going to business school in the US. And when I went to business school, I was very clear on what I wanted to do with my life. And I got out of it, I had really no clue. So I ended up becoming a consultant, doing strategy consulting at McKinsey, based out of Pittsburgh. And again, accidentally or fortuitously, my first project was for a large traditional bank processor. And so there are no plans of being a financial services guy, but that's what I ended up becoming. And over 3 years at McKinsey, I spent, 90+% of my time doing financial services in the US. And then I transferred and I was working out of Europe. And then a classmate from business school and good friend whom I'd stayed in touch with, Josh Reish, he sent me an email saying, let's start a retail bank. And you'll see how crazy I am that in 2009, I thought that that was a good idea. I mean, like I had more experience like shutting down banks at that point than starting them, right? Working on like large country bailouts and like large bank turnaround projects, because that's what all of 2008 and 2009 was for in the consulting world. But I got excited about the vision of a simple, easy to use bank that actually helped customers solve their problems using data rather than trying to like have like gotcha fees, which every time you trip up, there's a fee for that, right? And really, we didn't think of it quite that way, but I think we were stumbling towards the concept of like helping customers with their financial health or financial wellness, right? So that was the vision. It was very compelling. I decided to jump into it with Josh, moved to New York in late 2009. And me and Josh started up Simple in his basement in Brooklyn, and quickly realized that we knew nothing about how to start a bank, especially because everything that I thought I knew about financial services in the US had completely changed between '08 and '09. And that was the period I was not in the US, right? So every year between 2000 and 2008, there were 100 to 300 new banks started in the US. There was a whole cottage industry of what's called de novo banking. There was consultants, there were websites, there was like a process. And people would start small community banks all across the country and do it in like 18 months. It was this cottage industry. I think from 2009 till now, there's been maybe 10, right? So, and actually, I think from 2009 to like 2016, it was zero. And so basically, in the aftermath of the financial crisis, the regulators basically said, no more new banks. And that meant, well, now we're like, hey, we want to start a new bank. How do we do that when you can't apply for a banking license? And we thought about it and we realized, look, we're not really changing banking regulation. And we're definitely not changing anything about balance sheets and lending and all the things that most of regulation is focused on. Really, what we want to change is the front-end experience of banking, the way customers interact with their banks historically. And even now, I would say for the majority of customers has been through the branch. We're like, we wanted to change that part of it, not the back end of banking. So we're like, hey, maybe we can do this as a partnership with the bank. And the answer is yes, we could. And in the process, we kind of invented the modern fintech bank partnership, bank sponsorship model. We basically took ideas that were in the prepaid industry and in the card industry and kind of melded them together to create this new thing called a neobank. And finally launched it in 2012. It took 3 years from first email to launch. And I like to say that we figured out how to do things by doing everything wrong before we did it right. but launched it in 2012, grew nicely. And then in 2014, it was acquired by BBVA, which is a large Spanish bank. It seemed like a great acquisition at the time. I mean, we had raised less than 20 million and we sold for like 117. So all the investors made money. There was $14 million, which was distributed to employees, excluding the founders. So a lot of employees we had customer service people who went out and bought houses after the acquisition. Of course, now it feels like we missed out a couple of zeros, right? But I don't think, at least I didn't have any sense of kind of how gigantic this industry would be back then. In 2014, a few months after the acquisition, I was at BBVA's headquarters in Madrid, and I heard about this idea of building a platform. And my immediate reaction was like, yes, please do it. The world needs platforms in banking. And if something like that had existed in 2010, then Josh and I wouldn't have spent 3 years building Simple, right? Like we could have launched it in 6-9 months, and then who knows what we could have done, right? So I got very excited about it, wrote some documents for them, became an advisor. And then long story short, a year later, I left Simple, moved to BBVA, and spent 2 years building API platforms for them, one in Europe and one in the US. And those were internal ventures at BBVA. And I mean, we built and launched them, and we even got customers. And I think for a while, it was the biggest quote unquote BaaS platform in the US. But the frustrating part of it was that we could never figure out how to truly like grow the business, right? So you could integrate into the open platform sandbox in a week, and it would only take you 15 months to get through compliance, risk, legal, and all the internal BBVA processes around that, right? And so it was super frustrating, and I left in 2017. And I didn't really have any plans. I thought I would take some time off and figure out what to do with my life after that. But I was talking to a buddy in a bar in Portland, and I live in Portland now, by the way. We moved Simple and like centered it in Portland back in 2011, and that's when I moved here. But I was talking to one of my buddies in a bar, and I was bitching to him about kind of the state of global payments and banking, and how we really just needed one platform on the internet where anybody could move money and transact with anybody else on the planet, right? And he was like, Shamir, you've been talking about this for like years. Why don't you just go do it? And I was like, fuck it, I am. And that was the kind of the genesis of SIla. Found my co-founders, put it together, started working on it full time in 2018 and launched in 2019. And the mission of SIla is to make it easy to innovate and program with money. If you wake up anywhere on the planet tomorrow as a developer and you want to program with email or voice over IP or SMS or any internet protocol, it's quick, it's easy. There's APIs, SDKs, just go do it, right? Now, the hard part is to compete with Google. But honestly, most people who are programming with email are not building superhuman or hey, they're just embedding some email flow into their app. It's quicker to do it than to talk about it. The moment you come to money, it's a completely different planet. Whether you're in San Francisco or Shanghai matters a lot. There's almost no APIs or SDKs. And even building the simplest financial flow can take like 12, 18 months, right? Now, I would argue that it is much easier to compete with Bank of America than it is to compete with Google. But again, most people who are programming with money are not building a neobank. I mean, there is a market of that. I don't know, there's like 50 neobanks in the US now, maybe 100. And a lot of them are growing nicely, so more power to them. But the vast majority of the market is businesses that need to move money and just want to automate that into their back-end workflows, their front-end workflows, their customer interactions, their supplier interactions. They're like, which business needs money? The answer is all of them, right? It's as intrinsic, it's probably more intrinsic to business than email. That's where we come in. The core of our product is a restored HTTP API platform that allows customers to, our customers are developers, people building and shipping apps. It allows them to onboard their customers, individuals or businesses, verify their identities, create digital wallets, link bank accounts, pull money in via ACH or card, hold it, and you can hold a balance for a second or a decade. It's the storage of money is intrinsic to the platform. Transfer it and then pay somebody else out at the end of some complex workflow, right? And the workflows are the use cases. There's more than 100 customers now. I think we have at least 25 different use cases.
It feels like like fintech is at this moment where like these platforms are just unlocking just so many different workflows, and they tend to be so much deeper than I think people assume at first glance. At least that's what we've seen so far in talking to folks. But let's sort of start at the top. There was so much great stuff there. I kind of just want to rewind a little bit to Bank Simple. I remember being an early customer, and I just remember it being this magical experience where you get sort of this like card in the mail. It was this really nice unboxing. It had this like nice rubber band around it, and it was sort of like, as a technologist, it was just like the coolest thing ever, and it just made using a bank kind of fun and cool. And so it was a very, I think, special product. And I just want to go back to that story for a minute. So the context here was it's 2008. The financial crisis had just happened. So Lehman Brothers had gone under. And that's the moment where you guys decide to start a bank. So walk us through like those first couple of years. So what was the path to market like? I'm sure that was like a long and windy road. So what were some of the big sort of like challenges getting that product out?
Well, the first was just wrapping our head around the idea that we couldn't get a bank license. Right? I mean, there was a McKinsey deck on how to launch a bank and in the internal McKinsey knowledge base. And it was like, go to Utah, get an ILC. It takes you 10 million in 18 months and you can spin up a bank. And this was true pre-2008. Right? 2009 onwards, it is not true at all.
What changed? Because I know today Square is trying to spend like hundreds of millions of dollars trying to get a banking license. What was the regulation that made it so hard to get a license?
There wasn't one. So theoretically, the difficulty of getting a bank license today is the same as it was in 2008. There is no actual regulation that changed, no law that was passed. I mean, Dodd-Frank was passed in 2010, July. This was 18 months before, right? And what really happened was that in late 08, the entire banking system came close to collapse, and the regulators had to bail out a bunch of banks, and then they passed TARP, and then they had to pick winners and losers, right? And say, hey, this bank gets TARP funds, so it gets bailed out, and and that bank doesn't get TARP funds, and then it fails, right? And honestly, for like I think the FDIC and most regulators, it's probably the most like traumatic experience that you can have, right? Like we've had a couple of customers who closed shop and their business didn't work out, and it's never fun watching a whole chunk of the industry do that. Right. For somebody like the regulators is probably extremely kind of like traumatic. But there was this one report which came out in late 08 or early, probably middle of 09, early 09. And it basically said that banks that were new were much more likely to fail than banks that were old, which is like, if you were a de novo bank started in, I guess, between like 95 and 2008, you were much more likely to fail than the community bank that had been around for like 20, 50, 100 years, right? And that was really the excuse that was used by the regulators to like say, hey, no more new banks. Now, the thing is, they can't actually just pass that as a law. They can't pass that as a regulation. The way it basically ended up working is like, you start a regulatory process that took 18 months to 3 years to get a bank license, now took 7 to 10 years, right? They can't say you're not getting a license. They can just make it infinitely hard, right? They're not required to grant you a license in any period of time.
And why is it that new banks are more likely to fail? Are they just more risk forward?
So I actually don't agree with that study myself, because what it did was it looked at all the banks that survived and the ones that failed. I'm like, wait, you have a problem here, because a lot of the banks that survived because they got TARP funds, right? And so if you went in and say, what would have been the world if nobody had gotten TARP funds, and would old banks have failed just at the same rate as new one? And I point out just one bank, which is Citibank, and which got a huge chunk of TARP money. And honestly, in late 08, without TARP money, Chase almost certainly would have survived. Citi almost certainly would have gone bust. And if you take Citi as just one bank from the survivor category to the failure category, you realize that the entire analysis switches. And you're like, no, actually, old banks are much more likely to fail. Because Citi itself is just such a large chunk of the banking industry that it accounts for like, 1,000 communities.
Yeah. Do you see that changing? It seems like that was
completely. It has changed completely. I mean, there is a new chairwoman of the FDIC, Yelena McWilliams. By the way, she has written blog posts in American Banker, basically saying, yes, the FDIC stopped approving new banks. That's changed. We want to approve new banks. Please come and apply, right? Now, she can't make the process easy, because that will also require a lot legal change. So it's not like you can get a new bank charter in 6 months. But we are back to the era of 18 months to 3 years to get a bank license. Probably, I mean, you could probably have done it for 10 million back in 2008. That's probably unrealistic now. Probably looking at more like 25 as your low end. It depends a lot on which part of the country. And it's a whole arcane industry of its own, but it's definitely doable again now.
And what do you think of so like in these last 10 years, like because of the regulatory environment, there's been a number of startups that have partnered with banks to basically expose APIs so people can build on top of existing banking infrastructure and help legacy banks sort of take deposits and be like a layer on top, right? And that's kind of what Bank Simple did too. So given that trend and sort of that technology now exists, what do you see as like the advantages to actually getting a banking charter? Or is it actually more advantageous to not have that cost structure?
Well, so it is a pluses and minuses sort of thing. And it comes down very much to kind of your business model and in some ways your long-term view of the world. I would say I am cautiously pro getting a bank license, but very much depends on which fintech you are, what you're doing, and how you're building. And kind of like, it's not a panacea for everybody. It's definitely not an option really for anybody who's like early stage. So Square can go get a bank license. Varo can go get a bank license. They've raised like 200 million plus, right? I don't even know how much Collins raised now. And yeah, for big late stage startups and companies, it's possible, not for early stage ones.
How would you think about the ROI on that 25 million spend? Is it basically like what's the benefit of having?
You're probably talking more like 100 million spend when you get all the way through it, right? 25 million would probably be the entry ticket for setting up a small one branch community bank in like Idaho or someplace. And that's like, well, who's doing that?
Right.
And
right. Why spend the 100 million? Why not just do it?
One of the big things that you get with a bank license is fractional reserve banking. You can take deposits from customers, which are FDIC insured, and then you can lend those out. Like that was the traditional business model of, where like the joke about community banking was it was a 363 business. You borrow at 3%, you lend at 6%, and you're on the golf course by 3 on Friday, right? For decades, that's sort of the business it was, right? Like you just had to make sure that you didn't lose too much on those loans. And the depositors didn't worry about whom you were lending to because they were FDIC insured, right? Like, so they didn't stand to lose money. You could still blow it up. Lots of small banks went bust even before 2008. Just like there were 100, 300 new ones started everywhere. There were like 10 to 100 failures every year. But it was a kind of a manageable thing, right? If you're in the lending business, access to insured stable deposits is hugely valuable because the credit industry is highly cyclical. Every 3 years on average, from like I saw like Hans Morris of Nika did this analysis from like 1971 to 2015. And every 3 years on average, there was a credit crunch somewhere. Maybe it wasn't a industry-wide credit crunch like 2008, but there was an auto credit crunch, there was a home equity credit crunch, there was a credit, like somewhere in some corner of the credit industry, like, you know, capital and liquidity just dried up and so relying on like the debt markets works. You can go borrow money. You don't have to get it from deposits. You can get it from, you know, institutional, many different, everything from like hedge funds to doing your own debt underwritten through like Goldman Sachs or whomever. And then you can go out and lend it. Which that itself is like a multi-trillion industry. So of course it happens. It's volatile. Just some random day, you'll find that in some corner of your auto lending industry, one company went bust. Suddenly everybody is freaked out. All your liquidity has dried up and you're like, I can't get capital to lend it out. Now what do I do? And now you go sideways for a year or you go bust. That doesn't happen to banks. They have stable deposits. They have the money of their depositors. Depositors usually don't pull their money. Now, 2008 was a little bit of an exception. We started seeing the beginnings of a bank run, and then the TARP and everything else kind of like shut it down. But the sort of bank runs that would wipe out the banking industry have not happened since 1933.
That's really interesting. So sort of what I'm hearing is historically banks have made their money lending, and some of these modern fintechs haven't had that in their arsenal, at least not in the way that traditional banks have. And the banking license unlocks that.
It does. And you look at companies like Lending Club, and no surprise that Lending Club went and bought Radius Bank which is now Lending Club Bank. But
Right.
they went public. They had, I would say, a pretty good business. I was a customer and I was happy with them. And then in, I want to say 2017 or maybe 18, there was a credit crunch. And I don't know much about that space, but liquidity for them dried up. Most of their money was not coming from small retail folks like me. Most of it was coming from large institutions. It dried up. There was a credit crunch, and their business really suffered. And having access to stable deposits would have been massively helpful for them. And now they have gone and gotten it, right? So if you're on the lending side, I think it is, you get to a point and scale where it is really a question whether a large lending company can be profitable and stable without becoming a bank. So I wonder for companies like Affirm, I would say Klarna as well, but then Klarna is in Europe. And I think in Europe, they are a bank in Sweden. So it's maybe not in the US, but it's probably eventually a matter of time. So again, Square has a massive lending business. No surprise that they are a bank. And for folks like Amazon, the thing changes again, right? Like Amazon is large enough that it can find its own capital without worrying about there could be a credit crunch in small business lending and Amazon can still make marketplace lending work because they're just Amazon. Right. Anybody will lend to Amazon. So if you can change the rules of the game, then maybe you can avoid becoming a bank again. But for a lot of people, I think it's inevitable in the lending side.
Got it. Yeah, I want to hear your thoughts on how this intersects with crypto a little bit, but I want to jump back to one more facet of the Bank Simple story, which is around unit economics. I assume that was like a challenge for you back then. I know it's been for a lot of neobanks today. You referenced how growth was hard. Can you help us understand sort of like what were some of the growth levers back then? I know a lot has changed and consumer perception has changed, but what was sort of like the early traction like, and what were some tailwinds and headwinds back in the early days of building a neobank?
What was growth like, and then unit economics. Let's talk about unit economics. And unit economics are not like fixed or set in stone, right? They changed over the kind of 2.5-ish years that I was there at Simple after it launched, and eventually I left, right? But the kind of the basic economics of a bank are that there's two sources broadly of revenue, which is net interest margin and non-interest income. So net interest margin is that the 6 minus the 3. You're making loans, you earn X, you pay Y, the margin in that interest net of what you pay out, that's your revenue, right? Historically, that has been the main source of revenue in the banking industry, right? The other is non-interest income, which is basically fees, right? Like if you charge a fee, whether it's like, closing costs on a mortgage or it's an overdraft fee on a checking account, that all adds up as well. From sort of I think from like the early 80s till now, kind of the holy grail in banking has been to increase non-interest income, right? Like the thing about non-interest income is that it is not sensitive to interest rates, right? Like the closing costs of a mortgage are the same whether you're making it at 6% or making it at 3%. So it's fixed. But interest rates on interest margins are heavily dependent on interest rates. The interest margin 363 is great, but can you lend at 6 and can you raise money at 3? Right now, the problem is like the whole industry is awash with money, but you making loans at scale is still hard, especially for banks doing it the traditional way, right? So the whole industry has been trying to move towards more non-interest income than net. And if you go look at like bank analyst reports and all of this, this is the kind of the holy grail that they always look on. How much is NII versus NIM, right? Which also means that banks have been on this trend of trying to fee their customers to death. So it's like, hey, if you can overdraft fees in the 80s used to be $10. And if you looked at most banks, overdraft revenue was non-existent, right? Because the service offered to customers in the occasional case, remember everything was check-based. Nobody was using debit cards. It basically didn't exist till the mid 80s. And so to prevent somebody from bouncing a check, which was illegal, it still is, and it could get them into trouble, you gave them an overdraft it was a very small part of the business. Now it's massive, right? So unit economics for a kind of a neobank are the same, right? Like you're kind of in the same business. It's just you're doing it in a different way. Are you making your money from net interest margin or non-interest income? The answer is, well, net interest margin is not really accessible unless you're lending. If you raise a bunch of deposits, there are banks who will pay you some money on those deposits, but it's very much dependent on the Fed funds rate. So take the Fed funds rate and say half of that That's probably what you can get from your bank partner. The Fed funds rate is like 20 basis points right now. So, and it has been for most of the last decade. There was a moment where it went up to like it got close to 3% in like 16, 17. And then, we're back in so it's not reliable and it's not enough for most startups through the last 12 years. Non-interest income is the question, like, are you going to fee your customers to death? That's kind of what they hate about traditional banks. But if you go with a no fee model, then where is your revenue? The answer for most, I'd say for a lot of neobanks, has been interchange. Interchange is when you swipe your card, the bank on the other side gets on debit cards roughly about 1.5% of it. This was massively changed in 2010 with the passage of Dodd-Frank. Dodd-Frank regulated debit card interchange and capped it at like 23 cents for any bank with assets over 10 billion. So if you go look at like Chase and BofA, they make 0.5, 0.8% on their debit card volume as interchange. It barely covers their costs because they have a huge cost base as well. When you're using 1980s technology, it costs in 1980s. So you don't get the value of like AWS, right? But you look at somebody like a Chime, they partner with only banks who are smaller than 10 billion in assets. So they do get the Durbin exempt interchange, which means that they're probably making, I guess, around 1.4% of card swipes. And for Chime and most neobanks, that is the biggest source of revenue.
So intuitively, it kind of makes sense to me that, like for banks, like publicly traded banks to grow revenue, like non-interest revenue is probably where they have like the most sort of flexibility and levers, because they can only push lending so much, right?
That's what analysts like, and that's what will drive up their share price.
Yeah, and it seems like the lower income segment was hurt the most by it, and that created sort of this opening in the market. I think when Bank Simple was in market, it was almost like too early, but Chime and a couple others sort of like were able to go through the doors you opened to some extent and go after this like heavily, feed to death kind of segment of the market, which was sort of like the lower end of the market in some ways. It's almost, and it seems like the interchange regulation helped them a little bit too. So that's really interesting how all of that comes together, and so that's really helpful to understand. If you could go back, what would you kind of like maybe think about differently or do differently in the Bank Simple days? Curious to hear how you think about that.
Well, first of all, I wouldn't sell, and I mean, we had options. We had a term sheet from for a Series C round at what was a good valuation back then. Probably missing a couple of zeros now in 2014, and it was just that we were deep in the sale process. We had so much momentum behind it. It's hard once you have an offer and everybody starts counting their dollars to actually back out of it even. And we thought about it, me and Josh, but we eventually decided it just wasn't the right thing to do. Now I second guess myself on that decision. But the only other thing I think which we thought about doing, and I never managed to get it done while I was there, and Simple actually I think never did it, was the 2-day early direct deposit. That's a feature that I know exactly how it works. I designed it, and I was like talking to Bancorp about it in 2013, and they just weren't open to it. And it required a change in the way that they processed ACH, which was tricky. But Chime on Bancorp figured out how to make it work. And I think that has been their killer app to get people to sign up, and not just sign up, right? It's like simple. I mean,
you want that paycheck direct deposited, because that's the key to interchange, right?
Exactly. And Simple, there were periods of time where we were adding 35,000 customers a month. So growth was never really a problem at Simple. What was hard was getting those customers to actually become active and stay active and switch to using Simple as their core transactional account. And that's where you got the most benefit out of it as well. And one of the biggest indicators for that is when people switch their direct deposit over. 2-day early direct deposit is a killer feature for that, because it's something that customers really like and value. And to do it, they have to get the value. They have to make you their core account, right? And so it's powerful. And I think it's become standard across the industry now, to the point where NACHA is beginning to make noise about trying to clamp down on it. And I think that's something that the industry needs to keep an eye on and try and clamp down on, because it's one of those things which the traditional banks still struggle with, but is almost every bank does it now.
So like when people talk about like CAC and fintech products and neobanks, the CAC is high, right? That's sort of like the common wisdom. But it sounds like what you're saying is getting people to sign up is not that hard. It's the activation that's hard. So why is it that signups are not that hard?
Well, I mean, signups weren't that hard for Simple back in 2014. Remember, there was zero competition, basically.
Yeah, right.
Now
right.
it's very different, right? Like I remember when we started doing like Facebook marketing in 2013, and we still had a wait list of people. So we hadn't even like cleared out the wait list, but we started experimenting with Facebook. Like our first month, our cost of acquisition was like $2,000 a person, but it was on like 10K of spend, right? By our ninth month, it was like down to $30.
Wow.
And $30 as a CAC was very, very workable business model for Simple, even with all the challenges we had back then, right? That was because, I mean, there was a point where Facebook assigned us 2 account managers, right? And we were just like, we're not spending anywhere close, which we are not spending enough to justify a quarter of an account manager. Why would we get 2? And they basically told us, look, there's nobody in the whole financial services space which is doing the sort of stuff you guys are doing. And so we want to learn from you. And so they assigned us those 2 to learn from us. But then, of course, once they learned from us, they went and sold all that to everybody else in the industry. So now, of course, everybody from Chase to Chime is advertising on Facebook. Every channel is saturated. It is not easy now to get customers. I mean, if you can keep CAC at, I'd say, below $100 a customer at scale. Now, CAC is very dependent on scale. If you're onboarding 1,000 end users a month, it's very different than trying to onboard 100,000 end users a month. But at scale, if you can keep it below 100, that is actually very, very good right now.
How do you think about sort of like the future in a world where neobanks have these accumulating advantages? Like with historical banking, each community needed its own like retail branches and ATMs. And so you had like sort of like hundreds and thousands, maybe not thousands, but you had like hundreds of these banks.
There's about 4,800 registered banks in the US, and I believe over 6,000 credit unions. So the sum of credit unions and banks is probably over 10,000. It's shrinking. In the early 80s, it was over 20,000 banks, and I think over 20,000 credit unions. So in my lifetime, it's gone from like 40,000 to 10,000. But it's still a lot.
I think that's a good segue into maybe some future-looking stuff. So looking forward, so we have like a couple of big neobanks, right? That's sort of like part of the fintech landscape in the US anyway, and probably a similar story in other countries too. How do you see this playing out going forward? Do you see a few players starting to dominate sort of like the neobanking kind of space, or do you see continued opportunity for like a lot of different neobanks? And how do you see sort of like ongoing fintech trends in the context of neobanks and also otherwise?
So one thing to kind of like understand is just like we're talking about like the global financial services industry, right? It's a 17 trillion annual revenue industry. By comparison, global advertising is like 600 billion. So that means financial services is 30 times larger than advertising. And you could make a strong case that like everything that the internet has done in its first 3 years is really just completely revolutionized advertising. But advertising is just like a very minor part of global GDP. Global GDP is like over 100 trillion. And no surprise, it's built off like financial services and manufacturing and logistics and travel, agriculture. That's what the real world is about. It's not really about advertising. It's like a very, advertising is like the scum on the top of the thing, right? The internet hasn't really revolutionized those sectors yet. And I mean, things like logistics and, this massive companies now, Uber and all of these, it's all really in the last 10 years. In financial services, out of that 17 trillion, I think you look at everybody from PayPal to SIla, the entire fintech industry of the last 20, 25 years is about 1% market share. And that's because 99% of it is still with 30,000 or more banks, wealth managers, and traditional financial services companies across the world, right? We're talking about the whole globe now, not just the US. I think in this decade, we're going to go from 1 to 10. So there is going to be massive change. The pandemic has just kind of sped up all the underlying trends, and Even your grandma probably had to figure out how to do banking on her mobile app in April of last year because none of the bank branches were open. You couldn't go to them if you wanted to. And no surprise that folks like Chime saw their biggest year ever last year. So one of my predictions is that financial services in 2030, I should say fintech and crypto, and through crypto as part of fintech in 2030 will be as big as all of tech was in 2020. So we'll see a handful of trillion-dollar fintech companies. We'll see few dozen $100 billion fintech companies and probably 100+ unicorns, right? And that's across the globe. I don't see fintech going from like 1 to 50. This is just too large an industry to change that rapidly. But it is going to feel like just like whiplash because 1 to 10 is
that's crazy. 1 to 10 is crazy. Yeah.
Yeah. And it's not a small industry at the moment either, right? But I think by market cap, like fintech companies are like 2% of all financial services. By revenue, they're probably 1%. No surprise that they're valued more, right?
Yeah.
So that's just kind of one trend. I feel like we will eventually see consolidation, right? Like there's really honestly no need there's no reason the US should have like 10,000 banks and credit unions. Fast forward to the future, which is not 2030. I don't know when it is, maybe 2050. It's a while off still. I would guess that we'll consolidate to less than 1,000 financial institutions, core kind of transactional banking providers, whatever they look like in the future will look very different. And they'll probably look more like a Chime than like your community bank. There's a whole debate of like universal banking. I don't know. I honestly don't know which way it's going to go. But I feel like we have a long way off before we get to consolidation.
How do you think crypto fits into this forward-looking picture?
It's kind of hard to say, right? Like crypto is basically like a new technology and it doesn't change the underlying trends, right? We would get from 1 to 10 this decade kind of with or without crypto. What crypto does is it enables, so one thing it does enable is sort of like permissionless innovation, right? If you wanted to set up an international lending company and you started today and you went out and got all the licenses and everything else, it would take you like at least 2 to 3 years, right? I mean, it is not trivial to say, hey, I am raising money from individuals in the US and Europe and lending it to individuals and businesses in like Southeast Asia. But if you decide to do that as a crypto project, you can probably knock it out over a weekend, right? Now, arguably, it's illegal, and you might get into trouble for it. And there's a lot of like DeFi protocols, and then there's who have been getting into trouble with like state and SEC regulators in the US. But reality is they're large and growing. So before you didn't get to customer number 1 without permission. Now the regulators have to come after you and figure out how to shut you down. And they typically only invest that time and effort if you get large enough. So you can get large enough and then solve your regulatory problems versus having to have everything buttoned up on day 1. So I see the potential for a lot more rapid innovation happening in the crypto space, a lot more innovation that is even kind of hard to imagine. And I think it will actually speed this up, right? Crypto is moving towards that vision of like one world, right? Like whether you're in Vietnam, whether you're in the US, don't know, don't care. Do you have an Ethereum address? Sure. You got some tokens? Sure. Doesn't matter how you got them, right? Now you can plug it into a DeFi protocol and you're in business, right? So that has never existed in financial services before, right? Like most people in the world can't even get access to dollars. I mean, was it Kissinger or somebody who said that the dollar is our currency, but your problem? So yeah, I see crypto speeding up innovation and speeding up the underlying trends, but in a highly volatile fashion. And the whole regulatory status and how the regulators deal with it is going to move in like fits and starts.
Shamir, this is I think a good time to transition to SIla since you're kind of straddling both of these worlds. Do you mind talking a bit about the products you're building and the problems that you're trying to solve?
I think the vision for SIla really came from like watching the fintech and crypto industries grow over the last like decade, right? I mean, you see all this like promise in the crypto space of like, I mean, there's of course lots of scams and all sorts of things happening. And that was happening in the traditional financial services world too. But you see so many like innovative ideas and and people who would never think of themselves as bankers, but who want to solve problems in the crypto space, right? But the two big problems that kind of endemic to all of crypto is one is just connectivity to the traditional financial system. Like when email got launched in the 90s, email did not have to integrate into the postal service, right? Like nobody expected that, hey, I have all these letters. I need some way of like emailing my letters and going back and forth. People just were like, whatever, we'll send fewer letters, we'll send more emails, and emails took off. That doesn't work with money because people already have it and they care about it. Right? And so you can't like just say, hey, I'm going to ignore the traditional financial system and build a new one from whole cloth with no connectivity. And it's that connectivity. It's like, hey, I have dollars or pounds or yen or whatever. I want to convert them into some crypto token and then convert back and do that seamlessly. Those on and off rails, as they're called, tend to be one of the biggest problems for crypto because that's where regulation bites. And that's the other big problem, which is that, hey, the regulatory status of crypto is completely unclear, depending on where you are. I mean, some parts of it have become a lot more clear. The regulators mostly don't understand it, and they struggle with the pace and change rate of innovation, right? They're used to seeing new business models in financial services emerge like every other decade. In crypto, it's like every other week, and they just can't wrap their heads around it. And they can't mostly control it or stop it or ban it either because it's on chain. But they can block it and ban it at the point of ingress and outgress, those on and off rails. So that's the biggest problem in the crypto space. And it's actually analogous to problems in the fintech space. Like if you say, hey, you want to build a fintech startup, what's your biggest problem? It's like, well, I need to get access to the payment systems. I need to get access to like ACH and cards and checks and wire, and I need to store money somehow. And then I need to program with it and build an app, right? And I think that's what we view it as. It's like the problem is programming with money. Now, you might want to program with it in a backend server with all your code in, I don't know, Node.js or Java or Python or whatever. Or you may want to program with it in a blockchain, right? And use that distributed model, and it enables a lot of things. Whichever way you want to do it, we want to support it because we are here to help people program with money. So we have, of course, our APIs, but we also have a stable coin on Ethereum, and we have customers doing like crypto exchanges and NFTs who leverage that. We do offer quote unquote on and off rails, both to fintech and crypto. Actually, honestly, we're like 50-50 in our customer base right now. And our goal is to just make it easy for you to build those applications. We never really viewed it as two separate things, right? And I think it's beginning to become clear as more and more fintech companies are like, hey, can I get some yield from like being in the crypto space, or can I like get access to lending or do all these other cool things? I mean, you look at like Robinhood and Square, crypto is a huge chunk of business for them, right? On the flip side, you see a lot of crypto companies being like, hey, can I build really cool, easy to use consumer style apps, which are like a joy to use, like fintech apps, and make all this like on and off chain stuff vanish? We're here for both of them.
So it sounds like if I have like a crypto wallet or a crypto product and I want to help customers move some money into it, or if somebody's got some USD coin or some dollars in a wallet that they want to move it into the traditional rails, SIla makes that possible. So those are among some of the use cases that your API enables in a composable way.
I'll give you guys an example of like two use cases, right? We have a customer called Fabrica, which does NFTs, but NFTs for land. So if you buy a NFT from Fabrica, you are legally entitled to a piece of land somewhere. It depends on which piece of land, right? And the NFTs all have different prices, and depending on the land, it's really the underlying land value. And you can go to Fabrica and they'll put your name on the title at the county office, and you can go build something on that land if you want, right? So they built that whole NFT infrastructure, and there's a legal like trust structure backing all of that. But then they also need to move money, because if they sell you the NFT, they need dollars from you, right? And they do all of that through SIla. We also have a customer called Constitution Lending, which does commercial real estate mezzanine lending. They don't have anything in crypto right now. It's a traditional fintech company. But again, they're taking money from investors, mostly accredited or businesses, pooling it and then lending it to commercial real estate projects. All of that goes through SIla as well.
So in the Fabrica case, so I've actually played around with their product. I think it's really cool. So you can buy a piece of land on OpenSea as an NFT. And so you pay in Ethereum, right? So like they receive Ethereum. So, and then what happens? How does that then end up in a bank account through SIla ACH?
Most of their customers are actually buying the land from them with dollars in a bank account, right? Many more customers have dollars in a bank account than have Ethereum even today.
Yep, makes
and
sense.
So the usual flow is a customer will find a Fabrica, like piece of land, which is really through some other website where there's a whole industry of land trading websites, right? And then they'll go to Fabrica, they'll onboard. When this Fabrica has an onboarding process, they'll link a bank account, and then they'll pay via ACH from their bank account to Fabrica, right? Now, on the back end, that onboarding is going through SIla, they're being KYC'd, and there's OFAC checks, and all the normal things that a bank would do is happening all through SIla. And then the ACH process is happening through SIla. And then we generate our Ethereum stablecoin when we get the dollars. And then Fabrica does what's called an atomic swap. And they say, hey, we're exchanging on-chain SIla USD for Fabrica NFT, and it happens atomically. Now, they've actually gone the next step and said, hey, what if you want to do seller financing, where the seller of the land wants to finance you? So you don't pay $20,000 today, you pay $200 a month for 10 months. And they do that all through smart contracts on the blockchain as well. And it's all automated, it's all on chain. You can, and it's pretty automatic, right? Like it would keep working even if Fabrica went out of business. So it's pretty cool. And I think it's the next step for the whole crypto space is to just like become part of the ecosystem and be the background technology, right? Like who understands how AWS works or how the internet works, but everybody uses it.
Shamir, are there any products that you're surprised, that haven't been built already?
I'm actually more at the other end. I keep getting surprised at the products that I see customers building, right? Like NFTs for land, PFM apps, lending apps, B2B, B2C apps, sneaker apps. I'm just like the kind of what is fintech or even crypto is like a totally, open question now. I'd say some people joke that everything is fintech. And I think that is true, right? But it's because everything is about money. And once you can program with money, you can let your imagination run wild and intertwine it into your app in ways that honestly, I can't even imagine. And I'm just talking about customers in our customer base that we have seen, and it's super cool.
Thank you so much for coming on and talking about your story. It was a really fascinating conversation, and we'd love to keep in touch and hopefully have you back sometime in the future.
Sounds good.